Something extraordinary just happened in the global markets, and almost nobody is fully talking about what it means yet. In the span of a single session, oil didn't just rise, it exploded. Prices surged more than 20% in a move so violent that seasoned traders immediately recognized it as something far beyond normal market volatility. These kinds of moves are extremely rare for a major global commodity. Oil markets are massive, deeply liquid, and usually move gradually. When they suddenly spike like this, it's usually because something much bigger is unfolding beneath the surface. And tonight, the ripple effects are already spreading across the financial system. As futures markets opened, the reaction was immediate. Stock futures began sliding sharply lower, with the S&P 500 taking a heavy hit before the trading week has even begun. Volatility is rising. Investors are scrambling to reassess risk, and traders around the world are now trying to answer the same question. What exactly just changed? Because oil is not just another asset on a chart. Oil is the bloodstream of the global economy. When energy prices move this aggressively, it doesn't stay contained within the energy sector. It spreads everywhere into transportation, manufacturing, food prices, inflation, and ultimately into the wallets of ordinary people. And that's why tonight's move matters far more than a simple spike on a commodity chart. Behind the headlines, the signals coming from the markets are beginning to form a much larger picture, one that involves geopolitics, inflation, fragile financial markets, and a global economy that may already be slowing down more than most people realize. If you connect the dots, the story becomes far more serious, because what we're seeing right now might not just be volatility, it could be the early stage of a much bigger shift. Welcome back to What Changes, where we break down the most important shifts shaping the global economy and financial markets so you can understand what's really happening behind the noise. I'm May. Before we go further, make sure you join our Telegram channel and follow us on X. I share real-time updates there whenever major market developments happen, especially during moments like this when events are moving faster than a full video can keep up with. You'll find those links waiting for you in the YouTube description, because tonight, the charts across the global markets are sending signals that demand attention, and the first place we need to look is the oil market itself. To understand why the markets reacted so violently, we have to start with the scale of what just happened in oil. In a typical trading environment, oil might move 1 or 2% in a day. Even a 3 or 4% move would normally grab headlines. But a surge of more than 20% in a single session is something entirely different. It is the kind of move that immediately signals panic, disruption, and a sudden repricing of risk across the entire energy market. At one point during the overnight session, crude briefly pushed above the $110 level before pulling back slightly. Even after that pullback, prices remained dramatically elevated compared to where they were trading just weeks ago. And that raises the obvious question: what exactly triggered such an extreme move? The answer lies in the intersection between geopolitics and energy supply. Tensions in the Middle East have escalated rapidly, and markets are now attempting to price in the possibility that disruptions to global oil flows could become much more severe. When key infrastructure, supply routes, or production hubs are threatened, traders move quickly to secure energy exposure before prices climb even higher. Energy markets are incredibly sensitive to geopolitical risk because the global economy relies on a steady and predictable flow of oil. Any threat to that flow can instantly send shockwaves through pricing. But there is another layer to this story that many people overlook. Oil is not just a commodity. It is also one of the most powerful economic signals in the world. There's an old saying among traders and economists that captures this dynamic perfectly. The best cure for high oil prices is high oil prices. At first, that phrase sounds counterintuitive, but the logic behind it is simple. When energy becomes extremely expensive, it begins to slow down economic activity. Consumers spend more money on fuel, leaving less for other purchases. Businesses face higher transportation and production costs. Airlines pay more for jet fuel. Shipping companies pay more to move goods, and manufacturers see their margins squeezed. Over time, that pressure begins to ripple through the economy. Demand starts to weaken. Companies scale back. consumers cut spending, and eventually the slowdown itself begins to reduce energy demand, which then forces oil prices back down again. In other words, extremely high oil prices often act as a trigger for the next economic slowdown. And this is where the situation becomes especially concerning, because the global economy was already dealing with stubborn inflation before this oil spike even happened. Recent inflation data has been hotter than expected, with both producer prices and consumer price measures showing persistent upward pressure. Central banks have been struggling to bring inflation under control, and policymakers were already walking a tightrope between controlling prices and avoiding a deeper economic slowdown. Now imagine adding oil above $100 per barrel into that equation. Energy costs feed into almost every corner of the economy, from the price of transporting food to the cost of manufacturing goods. Oil has a way of amplifying inflation across multiple sectors simultaneously. And if those costs begin filtering through supply chains over the coming months, the inflation battle could become much more complicated. But the oil market is only one piece of the puzzle, because while energy prices were exploding higher, something equally important was happening across the stock market charts. And those charts are starting to reveal a warning that many investors may not be ready for. While oil was exploding higher, the stock market was sending a very different message. As the futures markets opened, the S&P 500 immediately started sliding. Within minutes, traders around the world could see that risk sentiment had shifted dramatically. Futures dropped sharply, wiping out optimism from the previous week and signaling that investors were rapidly repositioning for uncertainty. But to really understand why this matters, you have to zoom out and look at the bigger pattern that has been forming in the market for months, because the warning signs didn't start tonight. They started much earlier. If you look at the structure of the S&P 500 over the past year, a very specific pattern has been developing, one that technical analysts know well. It's called a rounded top, and it's one of the most important distribution patterns that can appear near the peak of a major rally. Unlike sudden crashes, a rounded top forms slowly. At first, the market continues to push higher, but each rally becomes weaker than the one before it. Momentum begins to fade, buyers become less aggressive, and gradually, the upward trend begins to flatten. To the average investor, the market still looks strong. Headlines still talk about growth, innovation, and new highs. But beneath the surface, something else is happening. Institutional investors, the large funds and professional traders, often referred to as smart money, begin quietly reducing their exposure. Instead of aggressively buying, they start distributing their positions into strength, while retail investors continue to chase the rally. Over time, that distribution process weakens the market's foundation, and eventually, a key support level breaks. That's exactly what we saw at the end of last week. A long-standing trend line that had been guiding the market higher since late last year finally gave way. Once that support broke, it sent a very clear signal to traders. The structure of the rally had changed. Even more interesting is what happened with the technology sector. While the S&P 500 managed to briefly push to a slightly higher nominal level earlier in the year, the Nasdaq never actually confirmed that move with a true breakout of its own previous highs. In technical analysis, this kind of divergence often acts as an early warning signal that momentum is fading. When major indices stop confirming each other's strength, it usually means the market is running out of fuel. Now combine that weakening structure with a sudden geopolitical shock and a massive spike in oil prices. The result is what we're seeing right now: volatility returning to the market very quickly. If selling pressure continues, the next important zone traders are watching sites near a major pivot area that dates back to the market's previous consolidation phase. That region acted as a key support level before the last rally accelerated higher. Markets have a tendency to revisit these areas once momentum shifts. But here's the critical thing to remember. Right now, markets are being driven almost entirely by headlines. Any new development related to geopolitical tensions could trigger sudden rallies or sharp sell-offs within hours. A single announcement about de-escalation could temporarily lift markets, while further escalation could push volatility even higher. In other words, we are entering an environment where the narrative can change very quickly, And when markets move into this kind of headline-driven phase, traders have to become extremely disciplined because emotional reactions during volatile periods are often where the biggest mistakes happen. But stocks are only one part of the story, because when we shift our attention to other major assets, Bitcoin, gold, and silver, something very unusual begins to appear. The signals from those markets don't entirely match the traditional playbook, and that discrepancy may be revealing something important about what could happen next. Now, here's where the story becomes even more interesting, because when global markets move into periods of geopolitical stress, there is usually a very predictable pattern. Investors begin shifting capital toward what are traditionally considered safe haven assets. Gold typically rises. Government bonds attract demand. Volatility spikes as traders move money away from risk. But right now, the signals from some of these markets are unusual. Let's start with Bitcoin. Despite the surge in oil prices and the sudden rise in market anxiety, Bitcoin has actually been holding up relatively well compared to many traditional assets. While there has been some volatility and short-term selling pressure, Bitcoin is still trading near the same general levels it was just a week ago. That might not sound impressive at first, but when you compare it with what's happening in other markets, it becomes much more interesting. The S&P 500 futures have been sliding. Precious metals are struggling to maintain upward momentum. Risk sentiment across global equities is clearly deteriorating, yet Bitcoin has remained surprisingly stable. This kind of relative strength often catches the attention of traders because markets frequently reveal subtle clues about investor psychology. When an asset refuses to collapse during periods of uncertainty, it can sometimes signal that underlying demand is still present. For Bitcoin, the key level many traders are watching sits around the $62,000 range. As long as price action remains within its recent trading structure, the chart still maintains a degree of short-term stability. What's even more fascinating is the sentiment surrounding it. Across social media and trading forums, bearish expectations have exploded almost overnight. Some traders are already calling for dramatic downside targets far below current levels. And while deeper corrections are always possible over longer time horizons, extreme bearish sentiment often acts as a contrarian indicator in the short term. Markets rarely reward consensus thinking, but while Bitcoin has been relatively resilient, the story in the precious metals market is far more concerning. Take gold, for example. Under normal circumstances, a spike in geopolitical tension combined with rising oil prices would typically send gold soaring. Historically, gold thrives during periods of uncertainty because investors view it as a store of value when traditional financial systems appear unstable. But that's not what we're seeing. Instead of breaking higher, gold has been struggling to maintain its momentum. The chart structure is beginning to resemble what technical traders call a bear flag. After an initial drop, the market attempted a small rally, but that bounce appears to be losing strength. And when a market fails to rally during the exact conditions where it should theoretically thrive, traders begin paying close attention because markets often reveal important information through what they don't do. If gold cannot attract strong demand during a moment of geopolitical escalation and energy shocks, it may indicate that the market expects broader financial tightening or liquidity pressure ahead. Silver, meanwhile, looks even weaker. After pushing higher earlier, silver has now been sharply rejected from its recent highs and appears to be forming a similar bearish consolidation structure. In technical terms, this kind of setup often suggests the possibility of another downward move before the market stabilizes. If that scenario unfolds, silver could revisit significantly lower price zones before establishing stronger support. And this creates an unusual situation. Oil is surging, stocks are weakening, Bitcoin is relatively stable, precious metals are struggling to rally. Each of these signals is telling a slightly different story. But when you connect them together, they begin pointing toward a broader macroeconomic environment that could become extremely challenging. Because the real danger may not simply be market volatility. The real danger is something economists have historically struggled to solve. To understand the deeper risk facing the global economy, we have to look beyond the charts and focus on the economic data that has been quietly emerging over the past several weeks. Because while markets have been reacting to geopolitical headlines, the underlying economic indicators have already been showing signs of stress. One of the most concerning signals came from the latest labor market data. The most recent employment report suggested that the labor market may be weakening faster than many economists expected. Job growth has begun slowing, and certain sectors are already showing early signs of contraction. Normally, a cooling labor market would reduce inflationary pressure and give central banks more flexibility to support economic growth. But here's the problem: inflation hasn't disappeared. In fact, several recent inflation reports have come in hotter than expected. Producer prices have been rising faster than anticipated, and the Federal Reserve's preferred inflation measure has also shown signs that price pressures remain stubbornly persistent. Now introduce a massive oil price spike into that environment. Energy costs are one of the most powerful drivers of inflation because they affect almost everything in the economy: transportation, manufacturing, agriculture, logistics. Nearly every sector relies on energy. When oil rises dramatically, those costs eventually filter through supply chains and begin pushing consumer prices higher. And that combination, slowing economic growth combined with rising inflation, creates the classic economic scenario known as stagflation. Stagflation is one of the most difficult environments for policymakers to manage. If central banks raise interest rates to fight inflation, they risk slowing the economy even further. But if they lower rates to stimulate growth, they risk allowing inflation to spiral out of control. It becomes a policy trap. Historically, stagflation has been associated with some of the most difficult economic periods of the modern era. And that's why the current oil spike matters so much. Because even if oil prices eventually pull back, the inflationary shock from this surge could take months to work its way through the global economy, which means the consequences of what happened in the oil market tonight could extend far beyond the next few trading sessions. Right now, global markets are entering a phase where uncertainty is becoming the dominant force. Investors are trying to price in geopolitical escalation, rising energy costs, stubborn inflation, and the possibility that economic growth may already be slowing beneath the surface. And when all of those forces collide at the same time, volatility tends to increase dramatically. The most important thing to understand in moments like this is that markets rarely move in straight lines. There will be rallies, there will be sharp reversals, headlines will constantly shift the narrative, but beneath all that noise, the key signals from oil, equities, crypto, and commodities are beginning to reveal a world economy that may be entering a much more unstable phase. That doesn't mean collapse is inevitable, but it does mean the environment is changing. And understanding those changes is exactly why this channel exists. If you want to stay ahead of these developments as they unfold, make sure you join our Telegram channel and follow us on X. I post real-time updates there whenever major shifts happen in the markets, especially during volatile periods like this, when events are moving faster than traditional news cycles. You'll find those links in the YouTube description. If you found this analysis helpful, subscribe to the channel and support the video so more people can understand what's really happening in the global markets. This is May with What Changes, and I'll see you in the next one.